On September 6th, 2022, Liz Truss became Prime Minister of the United Kingdom. 17 days later, her government unveiled a plan to cut taxes by £45 billion, with no plan to pay for any of it. 3 days after that, the British pound fell to the lowest level against the dollar in the currency's entire history. 2 days after that, the Bank of England had to launch an emergency intervention, buying government debt on whatever scale necessary, just to stop the country's pension system from collapsing. And 44 days after taking office, Liz Truss announced her resignation, the shortest tenure of any prime minister in British history. She wasn't voted out. There was no scandal. She was taken down by a market most people can't even define, a market that doesn't trend on social media, doesn't get covered like the stock market, and yet turned out to be powerful enough to end a government in under 2 months. That market is the bond market. And once you understand how it actually works, you'll never read financial news the same way again. Here's the thing about bonds. Almost everyone treats them as the boring cousin of investing. Stocks are exciting. Crypto is exciting. Bonds sound like something your accountant uncle brings up at Thanksgiving. But bonds are the actual machine that decides how expensive your mortgage is, whether your job is safe, what your retirement account is worth, and, apparently, whether a prime minister keeps hers. Stick around, because by the end of this, that trust story is going to make complete sense. More importantly, you'll see the exact same mechanism sitting quietly underneath your own bank account right now. Let's strip away the jargon and start small. Say your neighbor, call him Marcus, needs $8,000 to fix his roof before winter. You've got savings sitting in a checking account earning basically nothing, so you offer him a deal. You'll lend him the $8,000. In exchange, he signs a note promising 2 things. He'll pay you back the full $8,000 in 5 years, and every year until then, he'll hand you $400, 5%, just for the privilege of using your money early. That signed note is, functionally, a bond. You didn't hand Marcus cash out of kindness. You made an investment, and he made a legal promise. In bond terms, the $8,000 is the principal. The $400 a year is the coupon. The 5-year deadline is the maturity. Marcus, the one who owes the money, is the issuer. You're the investor. Now scale that up. Instead of your neighbor, it's the US Treasury borrowing to keep the government running. Instead of asking one bank for a loan to build a new factory, a company sells thousands of these notes to investors all over the world because no single bank wants to write a check that big. The logic never changes. Somebody needs money now. Somebody else has money sitting around. One side pays a fee, interest, for the privilege of borrowing it early. So why not just go to one bank or sell off a piece of the company instead? A bank loan caps how much you can raise. A bond sale lets thousands of investors each fund a slice of the same debt. And selling shares means giving up ownership, which is exactly what a business or a government usually wants to avoid. A bond lets you raise money and keep full control. The trade-off: unlike a dividend, which a company can quietly skip in a rough year, a coupon payment is a promise. Miss it, and you're in default. Here's where it gets interesting, because your deal with Marcus isn't locked in forever. Say 2 years pass, and you suddenly need cash for something else. You decide to sell Marcus's note to your friend Dana instead. Most explainer videos throw a wall of jargon at you right here and move on. But this one detail, that a bond can change hands, and its price when it does, is actually the key to almost everything else that follows. And the way that price moves is where things stop being intuitive. Here's the rule that trips up almost everyone the first time they hear it. When interest rates rise, the value of existing bonds falls. Think about Marcus's note. You're offering it to Dana, and it still promises $400 a year. But say that in those 2 years, new 5-year notes are now being issued paying 7% instead of 5%. Dana isn't going to pay full price for your slower paying note when she could get a better deal elsewhere. So you discount it? Maybe you sell it for less than the original $8,000. Marcus still pays the same $400 a year. That part never changes. But because Dana paid less to receive that same $400, her actual return, her yield, is now higher than 5%. That's the whole trick. The coupon is fixed. The price moves. Yield is just the coupon divided by whatever price someone actually paid. Bond price and yield always move in opposite directions, 2 ends of the same seesaw. This isn't just a theory problem. It's the exact mechanism that took down one of America's most important banks in 2023. Silicon Valley Bank spent the early 2020s doing something that felt completely safe at the time, taking customer deposits and parking a huge chunk of them, over $100 billion worth, in long-term government bonds, back when interest rates were sitting near zero. Boring, low-risk, textbook banking. Then the Federal Reserve spent 2022 aggressively raising rates to fight inflation. And remember the rule: when rates rise, existing bond prices fall. SVB's massive bond portfolio was quietly bleeding value the entire time, on paper. For a while, that didn't matter. because SVB wasn't planning to sell those bonds. But its customers, mostly tech startups, started burning through cash faster than expected and began pulling deposits. To cover those withdrawals, SVB was forced to actually sell part of that battered portfolio, turning an invisible paper loss into a real one, about $1.8 billion, almost overnight. The moment the market saw that, depositors panicked. In a single day, customers pulled roughly $42 billion out of the bank. 2 days later, regulators shut it down, the second largest bank failure in US history. And the root cause traces straight back to something that sounds as dry as rising bond yields. That's not a classroom example. That's thousands of people getting laid off, startups scrambling to make payroll, and a genuine scare about the entire banking system, all downstream of a bond price falling. Which brings us back to Liz Truss. Her government announced £45 billion in unfunded tax cuts. Investors looked at that plan and essentially said, if you're going to borrow this much with no plan to pay for it, we want a lot more interest before we'll lend it to you. That's the market repricing risk. Yields on UK government bonds, called gilts, didn't just rise, they spiked. In 4 trading days, the yield on the 30-year gilt jumped from around 3.6% to over 5%. That sounds small. It set off a chain reaction. British pension funds had spent years running a strategy that assumed gilt yields would stay fairly stable. When yields exploded higher instead, and bond prices sank, those funds got hit with sudden demands to post more collateral. Essentially, put up cash right now or the deal's off. The fastest way to raise that cash was to sell even more gilts, which pushed yields even higher, which triggered even bigger collateral demands. A doom loop, spinning faster by the hour, threatening to blow a hole through the UK's retirement system. The Bank of England had to step in and buy roughly £19 billion of gilts just to stop the spiral. The government reversed almost the entire tax plan, and Liz Truss was gone, not because voters turned on her overnight, but because the bond market looked at her government's borrowing plan and simply refused to lend on the old terms. One more concept worth knowing, because you'll hear it constantly whenever people talk about recessions: the yield curve. Think of government bonds like a parking garage with tiered rates. Park for an hour, it's cheap. Park for a week, you'd expect to pay more, because you're committing further out, and more can go wrong in the meantime. Under normal conditions, that's exactly how bond yields behave. Lend the government money for a month, and you get a small return. Lend it for 30 years, and you demand a bigger one because you're carrying more uncertainty over more time. But every so often, that flips. Short-term bonds start paying more than long-term ones. That's an inverted yield curve, and it usually means investors expect the economy to slow down badly enough that rates will need to come back down eventually, so they rush to lock in today's long-term rates before that happens. It's not a guarantee a recession is coming. Think of it less like a crystal ball and more like a smoke detector. It doesn't tell you where the fire is, it tells you something's worth paying attention to. So let's bring this back down to your actual life, because none of this stays contained inside the bond market. Mortgage rates are priced off long-term government bond yields, because your bank is competing with the returns investors can get from a safer government bond. When Treasury yields climb, your mortgage rate climbs with it, sometimes within days. Your retirement account, if it holds bonds at all, loses value whenever yields rise, even though nothing about the underlying business changed. Stocks feel it too. When a government bond starts paying 5 or 6% guaranteed, investors ask why they'd bother with stock market risk for a similar return, and money quietly rotates out of stocks and into bonds. And your job? SVB already showed you that one. Rising yields ripple into corporate borrowing costs, hiring decisions, and layoffs. Then there's the government itself. Right now, the US national debt sits at nearly $40 trillion, and the interest on it alone runs at roughly $3 billion a day. Every dollar going toward interest is a dollar not going toward anything else, and a huge share of that debt has to be refinanced at whatever rate happens to be sitting there when it comes due, which means the bond market doesn't just influence government spending. In a very real sense, it has a vote on it. So next time a headline says, "Treasury yields jump today," you won't scroll past it. You'll know that's a sentence about your mortgage, your job, your retirement, and quite possibly the political future of whoever's in charge. Bonds aren't boring, they're just quiet, right up until the moment they're not. And by then, as one particular prime minister found out, it's usually too late to do much about it. If this connected some dots for you, that's exactly what this channel is here for. So consider subscribing, and I'll see you in the next one.